Hi, welcome to Market in a Minute. We hope you had a great 4th of July. I really like that holiday. I really like summer. I wish we could experience summer all year round, basically. But the market itself is in an overbought condition, and we're going to see some headlines on tariffs. So we think there's probably going to be a pullback in the overall market. But the second quarter earnings look good, so we'll see how the market reacts to those good numbers that are probably coming out in the next couple of weeks. So we want to review the first half of the year. I think by doing so it gives us some insights of what happened and what may occur in the second half of the year. So the market update. The market's overbought. There's a lot of good news that came into the markets. You can see here from this move from June 20th, straight up move, last couple weeks. So we think there's going to be a pullback. So we're nicely above that 20-day moving average. The technicals are actually pretty positive here. So the tariffs coming back as headlines. As we all know, Trump negotiates in public. He doesn't do it privately. And so he may put out there something onerous on a large economy to get them to come to the table. The valuations of the S&P 500 are high, roughly 22 times. But as we've discussed, last several weeks, interest rates are going to drop. We feel pretty confident in that statement that the rates are going to come down, and with some stimulus from the government and the money pouring into the U.S. to invest, that economic growth will accelerate as we go into the latter part of this year, and in particular in 2026. So we need to see, what the 2026 earnings look like. So as a market gets closer to 2026, it's going to start to probably discount that. We think that the 2026 earnings are going to be probably better than most people expect. What we're doing, to repeat myself last number of weeks, we are planning on taking profits. Hopefully the market continues up into these good earnings reports in the second quarter, take some profits, get a little bit more defensive for that August, September, October period where we're likely to get a pullback. Review the first half of 2025. Now the S&P, what a first quarter and second quarter. So from high to low, it dropped over 20%. So we had a little mini bear market in there. It is in the first quarter, it was down 4.3%. As I mentioned, it was down from high to low 20%. And then came back strongly in the first quarter, up darn near 11% in the second quarter. So nice rebound in the second quarter. The PE at the low was about 18 times. So just keep that in mind for future references. 18 times earnings for the S&P. It's currently 22. So we think probably what happens is the market's looking out to next year. When it does so, probably the downside is about 20 times earnings. So if we get a 10% pullback, we would be much, much more aggressive. However, we're reasonably invested currently. The QQQ fell, the NASDAQ fell about almost 26% from high to low, and turned out the end of the first half up 8.2. So it had a really massive rally in the second quarter and off the bottom. Particularly the month of June was a really strong month. So the Dow's lagged. Didn't go down as much, didn't go up as much, up 3.6% for the first half. Russell 2000, it got clobbered, right, down 30% from high to low. Ended the first half down about 2.5. We really like this one for offense, so we think that in that August, September, October period, if there's a pullback, this is a great way to get some exposure for a really strong 2026. But we don't like it at all if the market pulls back. We think these stocks still have some downside to them. Reasonable amount of downside to them if the market rolls over. EFA, so the international stocks, so this is ex-US, ex-Canada, first half of the year up over 20%. So what's driving this? I think the main thing that's driving it is that 2024 started out in a really, excuse me, 2024 ended in a really oversold condition for the international stocks. So it was going to go up 10% anyway, just on the bounce back. But the European Central Bank's been cutting rates. They're down to 2% on what's the equivalent to their federal funds rate, and we're at 4.4%. The strength of the markets, break it down some more. Semiconductors up 15%, really strong. Industrials, probably good reason. Everybody's trying to get more electricity built, and a lot of investment opportunities from international investors coming to the U.S. building plants. So that's what's driving, the semiconductors and the industrials. It's more cyclical. The Mag 7 underperform, and we think it's going to continue to be, just a ho-hum area to be of the overall stock market. And then the laggards been the biotech, the small, medium cap biotechs, really weak. We've done our emerging healthcare done really well. Actually, it's up 14% year to date, while this XBI is up is down 6. So we got about a 20% spread over the index. That's huge. Consumer discretionary stocks have lagged. Healthcare stocks have lagged. This is where we want to fish in right now. So this is the ponds we want to fish in, these areas that have lagged for opportunities. And then as things come down, then we'll go back and look at more of the leading stocks in the S&P 500. So here's the S&P. I'm going to explain this chart a little bit to you. So this is the purple line is the 200-day, the red's the 20-day, the yellow is 100-day, and the green's the 50-day. So I probably my favorite of the moving averages is the 50-day, but you have to give the 200-day its due respect. So when basically the thought behind technical analysis is as you break the 200-day moving average, you really want to be really cautious because you can see how it broke here, broke down through the 200-day, really got oversold. But you don't want to wait until it comes back above the 200-day before you start investing. So you want to start to do it prior to that. So this gave us a nice oversold condition here. So the oscillators, gave us an oversold condition. But you at a minimum, you want to start investing when it crosses that 20-day and the 50-day. Like I mentioned, I in particular really like the 50-day moving average as something to really watch closely. So, we had this big pop here. We think it probably pulls back to the 6,000 level, potentially, I would say. And that would probably be an area where we would watch it very closely to put some capital to work if it holds that area. Now, the triple Qs, the NASDAQ, looks very similar. Big oversold condition, big rally. The Dow, same way, just a little less volatile. And the Russell 2000, what a massive decline this was. So 2450 all the way down to about 1750, massive decline. So this has basically gone through a really big bear market, and it's coming out of it. So I love these patterns when it breaks above the 20 to 50, the 100-day, and now it's approaching the 200-day. We think it's got to rest, though. But you can see it's nicely below the prior high. So put Russell 2000 on your shopping list. Just put it off until the August-September period where we might get some downward volatility. EFA, like I mentioned, big move, and we think it's probably going to start to tire out. We would not be investing very much in the international area. The semiconductor stocks, this has been the big winner, but again, it was the big loser at the in this correction, and it's come out of it very nicely. So the semiconductors is an area that we want to be invested in. We want to do it smartly. And so we've missed some names there, but we got some right. So we were looking for a pullback in this area to get more exposure. The industrials, this gives a little bit more detail than the other charts, but you can see here, big pullback, big rally. What's working in the industrial space is the more cyclical stuff, the more defensive stuff like waste management, really good recurring revenues. It's underperforming versus the more cyclical stuff, and the most recent month of June actually. So you can see the Caterpillar tractor. This is a play on AI. So they have a division that does backup energy, energy production. So this is something that the AI sites, the data centers need. They need that backup power. Generac, you can see that's done very nicely as well. So the industrial space is the area we like. Way overbought at this point. Not really pushing anything there. Emerson Electric is a very conservative name, and probably should be on our shopping list, if it has a nice pullback. Communication services, this is one of the better performing areas. So year to date, it's up 12.7% year to date. So like the industrials, 12.7% basically as well. And the semiconductors were up 15%. So kind of going in descending order. The communication area had a nice pop back. We would completely avoid names like Verizon. We think Verizon is dead money. Utilities. So again, what's been moving is the hot stocks, the alternative energy area, Vista and Constellation supplying power to the data centers and in unique ways. And so utilities have been a strong area, but it's not really been driven by the real basic utility companies. It's more of the sexy stories in the group. Information tech, Oracle had a big move. Unfortunately, we didn't see that coming. Up 32%. Good quarter. Some good announcements around that quarter. Micron's been something that we've liked. AMD's been another name that we've liked. We probably need, as I mentioned, more exposure to semiconductors at the right time. And then onsemi is a play on the automotive area, and that's starting to pick up. So just think about that a little bit. Maybe the autos have a better 2026 as well. But the stuff that's not working is the more conservative companies like AMD, and then Gartner Group is more of a consulting group. Ascend the same way. So kind of the non-cyclical stuff is not really performing in the tech area. So we would expect a pullback in the tech stocks. This move's been really, really strong off the bottom. Year to date up 9.3%. June was really strong. It was up almost 10% in June. The financials. So this is an area that we like. I'm not sure why Coinbase is put into this category. Coinbase has been strong. The sector is up 9.1% year to date. It's been a good area. Our favorite stock's been Citigroup. You can see that was up 13%. And then again, the more defensive names like the insurance companies, all underperforming. The materials. So this could be a big winner for next year. So what's going on there is with the tariffs, really protect some of these, like International Paper is lagging. So that's maybe something to look at. Dow Chemical, it needs a good China, really. The chemical area, this needs good global growth, and maybe we'll get that next year. But Dow Chemical is a really cheap stock. Nucor's been performing well, steel. So what's going on with the Trump policies helping out that sector? Artificial intelligence. I'm surprised that this hasn't performed better. It's up 4.8% through the first half. So this is an interesting area of the market. but it's not performing as well as some of the more cyclical areas of the market. Consumer staples up 4.3% for the first half, and this has been a tough area. So you can see names like Kimberly down. This is for the month of June. Campbell's, ConAgra. I like ConAgra. They've got some commodity exposure there. Have you noticed that the beef prices, how much they've gone up? So a little bit of a beef shortage going on in our country. But look at this group. Look at the chart here. So pretty consistently around that 83 level on that ETF, 84, between 82 and 84 is the high point. It's currently 80. It gets down to 76. Not a lot of risk this area. So to play the range, I think it makes sense. Right now, it's kind of in the middle of the range. So nothing to really do there. But there's some really cheap stocks there that kick off big, big dividends. So as rates start to go down, this group will start to percolate a little bit because they'll be interest rate sensitive. They'll get some nice. There'll be a nice premium paid for those higher dividend paying stocks. Real estate, really nothing going on here. There's very little movement one way or the other. It's kind of stuck in a very narrow trading pattern. Again, way oversold, we play it. Way overbought, we'd sell it. I don't see anything to do in the real estate sector currently. The Mag 7, so up 1.9% year to date through the first half. So it's underperforming. So we think that this will probably continue as other sectors of the market start to perform better. That's going to attract the money. The energy sector, again, this is a nice way of, this is a nice trading group. It's up barely 0.6% year to date. So it hasn't really gone anywhere. With the SP up 5.5, it's underperformed. However, we've had some really good trades here. So as you know, we were concerned about Iran and Russia. The stocks were washed out. Not really concerned about Iran, but we thought it was a catalyst. But the stocks were washed out. Russia is what we're concerned about. And so, when these things get washed out with these geopolitical risk around, these are just easy ways to make some money. Now, we would like to see it pull back some more. Ultimately, maybe hold this 50-day moving average. And, if we can buy it there with the thought, okay, Russia is a potential catalyst for this group. You never can tell. I know Trump and Putin are talking, but it doesn't seem to be going anywhere very fast. So this might set up for a very nice trade. If Russia goes offline, we could see oil prices above $100, and this index would absolutely fly on that. Okay, healthcare. This is a sector I think it's worth finding some good ideas in. So you can see there's not big movement in this sector, and some of the defensive names have performed really well. We like names like United Healthcare that really got beat up. We don't think that there's fraud in United Healthcare or anything that's worth indicting them for. So this is a group that there's some value into it. I would go with the higher quality stocks. However, we really do like the emerging biotech, and I'll talk about that in a second. So the performance of this sector down about 1.2% for the first half. So this is an area that there's clearly some value in. It's underperformed. Consumer discretionary, some nice pops here. So our analyst is looking at Lululemon saying, we ought to look at this. I don't disagree. And this has been a really competitive area of the overall market. We follow Gap closely, and their Athletica line has been struggling. So it's not quite there yet, probably. But we're looking at Lululemon as a really quality play into a nice probably turnaround as we approach 2026. The cruise stocks in the month of June have been really strong. Nike, it's really interesting. Dick's is acquiring Foot Locker, right? And so they have a good relationship with Nike. So maybe that helps the group, um, the shoe group. The sector's down 2.7% year to date. We like the specialty retail guys. We like Gap, Abercrombie and Fitch. A couple others we like there as well, like American Eagle and Urban Outfitters. So there's about four stocks that we think we can make some money in. And if they surprise nicely on the upside, these stocks just scream up. So our favorite's probably Gap. Urban Outfitters, we think it's got the momentum in their business, really strong momentum in their business. So that's probably worth taking a close look at as well. The biotech area, small cap biotech. So it's down 7.9% year to date. Don't own the sector. Don't own the group. Don't buy the ETF. If you're going to do this, you got to hire someone like me to manage your money. We specialize in small cap biotech, something that we do. We love doing it. Besides our more defensive strategies. So this is a nice area of the market to look for some great values. And as always, big winners and big losers. So this is where all the fun is in the market, in my opinion. As I mentioned earlier, our emerging healthcare, this is through last Friday, or I should say Thursday, the 3rd, up 14% year to date. The index down 6% from that point, up 20% on a relative basis. We're beating the overall markets by 3x at this point. The S&P. This is something that we can find some great values in. Well, we think we have some big catalysts coming in the second half of the year. Oh, let's go look at the valuations again. So again, 22 times earnings. This is where it's going to struggle. So if you look back over the last 10 years, roughly, it really struggles around that 22 times earnings. However, we probably have a really good outlook in front of us. And with lower interest rates, stimulus in two different ways, money coming into the United States to invest in plant and equipment, and then secondly, the benefits of some tax cuts. We actually think that there's going to be pressure taken off of the borrowing. So actually the longer term treasuries could perform better. We're not crazy about the big beautiful bill, but it cuts the deficit quite a bit. So they're looking for roughly $3.8 trillion in deficits over the next 10 years. Probably better than that. But that's only a $400 billion run rate. So obviously the first 1 or 2 years is going to be higher than it to come down. But to have $400 billion deficits, that's a real big positive. The mid caps, 16 times earnings, much more interesting than the large caps, which up here at 22. And small caps, we've been wanting to play this space. It just hasn't quite set up right for us. We've had some really good individual ideas. So we want to play the Russell 2000 when the timing's right and take a nice size position in it. And so we think we're getting there. We're not quite there yet. We have a pullback. These names are going to pull back more than the overall markets. Market sentiment. We're really surprised how much the market sentiment's popped. So from 2 weeks ago, we were at 35%. Last week, it ended at 45% bulls. So 35 to 45 bulls, that's a big move. That's where it's probably going to start to tire out. See, the sentiment's kind of turned positive, right? So, we've got 45 bulls to 33 bears. That's a big movement from we had, early in the year, 62% bears. Now we're down to 33. So as I mentioned, we do think we're probably going to get some good news from earnings, and then we would be taking some profits into that. Shiller PE, I'm not a big fan of Shiller PE, but it's a 10-year kind of run rate of the earnings. So it's back to a very high level, but I don't gather anything really relevant out of that we haven't already talked about, of having higher valuations in the market than where it starts to tire out. But we have a positive view on next year. And then this is another way of looking at sentiment. So, this looks at a couple different things in the sentiment. The cash levels are still high, so we can see that the cash probably coming down and fueling some of this continued rally in the markets. We hope. So one thing I do like about what we do, we're very loss averse oriented. So we don't like to lose money. If we're wrong about anything, we can move quickly, protect the downside very quickly, and hopefully avoid any sort of major declines in the overall markets. So if you ever have any questions, come to my website, Patrick M. CFA, sign up for a hard copy of Market in a Minute. We'll send that to you every week. And then if you have, if you want us to help you manage your money, if you're an individual, we can do that. And then also if you're a financial advisor, that's where we really focus. We can help you and your clients with your practice. Take care.